Building a safe, simple, and winning strategy, pairing bullish and bearish ETFs. The SPX Timer Ultra Strategy. Would you like your investments to grow 30% per year? Would you like to have 75% winning trades? Would you like to do this without trading options? Would you like to do this in your IRA? Would you like to do this simply by trading the S&P 500 with only 2 ETFs? If so, give me just a few minutes and I'll explain how it can be done. These are the elements of the SPX Timer Ultra Strategy for the S&P 500. We use the S&P 500 for safety and diversity. SSO and SDS as our 2 ETFs for simplicity. The SPX Timer as our market timer. Momentum to achieve coordinated entry. And money management for the preservation of our profits. I'm going to show you the role each element plays in this strategy. The S&P 500 is 500 of the most widely held U.S.-based common stocks, chosen by the S&P Index Committee for market size, liquidity, and sector representation. Leading companies in leading industries is the guiding principle for S&P 500 inclusion. We are starting to build our strategy with the S&P 500 to achieve safety and diversity. Wouldn't mutual funds be better? According to the Motley Fool, during the 1900s, the S&P 500 has provided an annualized return of 17.3%, compared with just about 14% for the average diversified mutual fund. Over the past 3 years, only 10 mutual funds had more than a 12% total return. You can see that the S&P 500 has not done well, but you would have actually done worse using mutual funds. This strategy will be simple. SSO and SDS are our 2 ETFs. They are ProShares Ultras for the S&P 500. They are leveraged 2-to-1. SDS is an inverse ETF. It rises when the S&P 500 falls. Invest in SSO when the market is rising. Invest in SDS when it's falling. This is really simple. You might wonder if this is a safe investment strategy. These ETFs are leveraged. Wouldn't it have been safer to invest in sound American stocks? Well, I don't think we have to discuss that issue. Stocks behave like the hair. You cannot predict in which direction they are going to run. These 2 ETFs, SSO and SDS, in comparison are turtles. Admittedly, they are turtles with racing stripes. At this point, we do not have anything more than a rough plan for investing in the S&P 500. This is not enough to qualify as an investment strategy. First, we need an unbiased indicator to determine in which ETF we should invest our money. Any day, the majority of pundits on CNBC will tell you the market is going to rise. But on the very same day, many of their pundits will provide reasons why it will fall. So you cannot rely on them. Also, the futures prior to open seem no more reliable for choosing either SDS or SSO. Something better is required. To this end, we have developed a market timer called the SPX Timer that combines the movement of the S&P 500 with market sentiment. This chart shows the results of trading SSO and SDS from September 2007 until May of 2010 using only the SPX timer. $10,000 invested on 9/12/2007 grew to almost $14,000. Most investors and funds didn't do that well over this difficult period. These results are not very good in terms of what we would hope to achieve. The average annual rate of return is about 14%. Look at the yellow oval in the middle of the graph. During that time interval, the investment fell from a high near $14,500 down to about $11,000. That's a big hit. We would like to sleep well at night. That fall would make sleep very difficult. Sometimes these ETFs do not move in sync with the market timer. I added a mild momentum constraint to the strategy to ensure the entry is in sync with the timer. The ETF's momentum, not necessarily the price, is required to be rising over 2 days. The $10,000 investment with this added momentum condition grew smoothly to more than $16,500. That's over 20% per year. It's seen after each big run-up in profit, there was a comparably big pullback. Many investment managers recommend adding to a position as it is rising in value. I decided to try subtracting from the position size as the profit rises. If timed properly, this might reduce the amount of profit given back. Plus, it would reduce the risk while adding some of the profit to the bank. Let's see how this unique form of money management is going to work. Say you started with $10,000. The idea is to keep the money at risk between $9,000 and $11,000. Whenever your equity grows over $11,000, sell enough shares to withdraw $1,000. This should reduce your money at risk to under $11,000. Next time it appreciates over $11,000, do it again. If, on the other hand, the investment falls below $9,000, add $1,000 worth to the ETF investment. Here are the results of the SPX Timer Ultra strategy. This investment grew to almost $18,000, or close to 30% annually. That's not bad for Turtle. 75% of these trades were winners, and you can see how it continuously grew over this period of time. We applied this strategy to other broad-based indexes. This line shows how we did with the S&P 500. Here are the two ETFs we used, SSO and SDS. 75% were winners. It grew to almost 18,000 and was close to 30% average annual rate of return. The NASDAQ 100 uses different ETFs. It had close to 78% winners, and the average annual rate of return was almost 35%, even higher. The mid-caps had an amazing 80% winning trades and almost 40% average annual rate of return. The Russell 2000 had almost 85% winning trades and over 40% average annual rate of return. To review, we start with safety and diversity. We achieve simplicity by using only two ETFs. The SPX timer is critical. We've added a coordinated entry to make sure the ETFs are in sync with the timer. And with an unusual money management scheme, we were able to achieve preservation of profits. Our subscription services guide you through our trades that employ all of these elements. We went live on March 1st, 2010. Just give us your email address to receive these results. There is no obligation or charge. Thank you for listening.